Good morning and thanks for joining us this morning. You're watching All You Need to Know on Bloomberg Quint Live. I'm Alex Matthew. First, the headlines. The U.S. Federal Reserve keeps interest rates unchanged but indicates that it is open to cutting rates to ensure sustained economic expansion. HDFC will purchase 51.2% stake in Polo Munich health insurance for over 1,300 crore rupees. The merger process will be completed in 2 steps. The Prime Minister's Economic Advisory Council, or the PMEAC, has rejected former Chief Economic Advisor Arvind Subramanian's claim that India's GDP growth between 2011 and 2016 was overstated. And the Finance Ministry is preparing a fresh proposal for the sale of Air India after failing to attract any bidders in the first attempt. Let's begin with the big development from overnight. The U.S. Federal Reserve kept interest rates on hold, defying expectations from the White House. However, the world's most powerful central bank has chosen to drop the word patient while describing its approach to monetary policy, hinting at a possible rate cut later in the year. Economists have suggested that the next move should be a 50 basis point cut. Kathleen Hayes reports.
Well, it certainly shows they're not ready to pull the trigger yet on rate cuts. Nevertheless, let's look at some of the things that just sent that signal quite apart from the dots, because the Fed dropped the word, the patient approach, to be patient on rates. That's no longer there. They also, on the other hand, talking about why not moving now, Jay Powell talked about, well, there's, we saw stronger retail sales, there's strength in consumer spending. The labor market still looks pretty good, but he also talked about cross currents, low inflation. They had to drop their inflation forecast for this year on the consensus from 1.8% to 1.5%, further from the 2% target. Trade war, weaker overseas growth. And let's look at the dot plot now, because that's what really drives home this new dovish stance. What you can see on the far right-hand side of your screen is the in from the left, that's the March meeting. See that long yellow line? Now we can see it even better. Then you can see the consensus was just hold steady. We don't know what we're going to do. Then you move over to the far right, and now you see there's fewer people holding steady. Down below, there's 8 that are looking for a rate cut this year. And in fact, Jay Powell, when asked at the press conference, said even the people who stayed steady, they didn't say we're ready to cut yet. They're still leading in that direction.
The projections of appropriate policy show that many participants believe that some cut in the federal funds rate will be appropriate in the scenario that they see as most likely. Though some participants wrote down policy cuts and others did not, our deliberations made clear that a number of those who wrote down a flat rate path agree that the case for additional accommodation has strengthened since our May meeting.
Clearly, the Fed chair went out of his way to make sure people realize that even what we saw in those dots is even more dovish maybe than you might think on the surface. All the more reason why markets are pricing in a rate cut, at least 25 basis points when they meet in July.
All right, and Jerome Powell also indicated that he intends to serve his full 4-year term despite, buzz that states that the White House isn't too happy with his performance so far. In fact, just this morning, just a short while back, Bloomberg sent an update saying that the president, or President Trump, believes that he has the authority to replace Powell at the Fed. We'll have to watch how that pans out. For now, let's talk about the markets. The commentary from the Federal Reserve also reflected on the U.S. markets, with benchmark indices ending higher, while the treasuries and the dollar saw weakness. Renita Young of Bloomberg News wraps up Wednesday's trading action in this report.
U.S. equities ended higher, with the S&P 500 within 1% of that record high it hit in April, all happening after the U.S. Federal Reserve decided to keep rates the same but adopted a more dovish tone, signaling that it may be ready to cut rates at some point very soon. This is also happening as recent U.S. data was really mixed and blurred the vision of how well the U.S. economy is actually doing. And in the background, there's still trade tiffs happening between the United States and China, with U.S. President Donald Trump to meet with Chinese President Xi Jinping at the G20 summit happening at the end of this month. Meanwhile, gold and WTI both traded higher, but the Bloomberg Dollar Index and the yields on 10-year treasuries were lower. And we still had some companies' news happen that was relevant today and exposed to trade relations. One one being Adobe, gaining as its second quarter adjusted earnings per share beat analyst estimates. U.S. Steel also beat analyst estimates with its second quarter adjusted EBITDA, and Southwest Airlines actually cutting its second quarter capacity on lower than expected completion and citing the Boeing 737 MAX 8 fallout, of which Southwest is one of the biggest global customers. And that's a look at your Wednesday Wall Street action. In New York, I'm Renita Young for Bloomberg News.
All right, now let's also take a check on the Asian markets while we're at it. Sophie Kamruddin is joining us from the Hong Kong studios. Good morning, Sophie. I see mostly green on the screen. What are the fine prints that you're picking up?
Well, the emphasis is on bond markets, so traders taking the Fed's dovish stance and very much running with it, keeping the rally in global debt markets going, which has pushed yields lower across the curve. Early in the Asia session, benchmark treasury yields have already dropped below 2% for the first time since 2016, and 10-year JGB yields are dropping about 2 basis points into the lower end of the BOJ's target range ahead of the central bank's decision today, when it is expected to stand pat. But Governor Kuroda may hint at an easing shift. And in gold prices, we're seeing a surge to 5-year highs on the easing shift, while the U.S. dollar is extending its decline, and the Kiwi dollar is gaining the most against the greenback, supported as well by the beat in first quarter GDP data from New Zealand. But that reading stayed close to a 5-year low, which may yet keep the door open for the RBNZ to cut rates again next week. And we also have policy decisions from Indonesia, Taiwan, and the Philippines today, and the Taiwanese dollar set for its best 2-day jump in 3 years ahead of that, while long-dated Indonesian and Philippine dollar bonds are jumping. So a busy day for bond markets, but a more muted reaction in equities, with stocks trading mixed so far in the session. Back to you.
All right, thanks so much for that, Sophie. You know, the Indian bond market has also been an area of focus. Let's in fact pull up the 10-year benchmark government bond yield just to give you an indication as to how it's currently trading, just about that 6.84. Of course, there was a cut to account for by the Reserve Bank of India at its last policy meeting, but the yield has been trending lower. In fact, just a short while it was higher than that 7% mark. Well, now let's turn to the equity markets. Agam Vakil is here to set you up for the day's trade and also what's happening in the futures and options space. Agam, well, how do we look at the start? I mean, you know, we set something up at the start of trade, and then it all, you know, turns on its head in the last couple of hours of trade.
Well, it's best not to make any guesses, Alex. We go with the flow. These are those sort of days, and we don't have any triggers too right now. So we're largely going to move, well, perhaps in tandem with what we are seeing in globe. Well, we are looking at about a 30-point up move in the SGX Nifty, but again, we cannot go by what the SGX Nifty is indicating, even though the opening may very well be in line with the SGX Nifty futures. But as far as yesterday's day of trade is concerned, we started very strong and then eventually closed the day, well, rather flattish, but there was severe underperformance from the broader markets, which includes the mid-cap and the small-cap indices. The banking indices, again, mixed cues, not too much change there. But how about the ADRs at this point? Some weakness in Infosys, Wipro, Tata Motors, and Vedanta, and actually, say for HDFC Bank, we haven't seen gains at all, and HDFC Bank also seen just 0.5% up move there. But coming down to your fund flows, and again, as you can see, there is no contribution, no participation from FIIs or DIIs based on the kind of numbers that we are looking at right now. This is the net number, and the gross numbers are pretty small too. And given the fact that it's been a flat day, well, HDFC Twins along with Kotak Mahindra Bank cancelling out, or rather being cancelled out by UPL, India Bus Housing Finance, and ICICI Bank. So again, you know, we've seen that with that cancellation, but it was the broader markets which did see severe weakness. But I'll come to that in just a bit. Let's move on and talk about futures and options. And well, we did see 4.5% increase in open interest, even though the benchmarks did not move. And the Nifty banking futures too did see about 9% increase in open interest. As far as your open interest distribution is concerned, well, of course, we're looking at the 11,800 and 11,900 calls with the most amount of open interest, and that they will provide some sort of, what I say, resistance on the higher end. And of course, moving on, in terms of changes, it was once again 11,800 call, which was the most active. But let's talk about your WIX, and it did rise, but it's still at a very comfortable level of around below the mark of 15. And the Nifty put call ratio as well, it again very neutral, largely unchanged at around 1.15. And coming down to your stocks which are in the F&O band, Divan Housing Finance, IDBI Bank and Jet Airways, PC Jeweler and Reliance Infra. So one will not be able to take positions in these beyond an intraday. BEML, IRB Infra were two stocks that stood out. IRB Infra is looking at a lot of weakness, including something like a Power Grid was the only one which actually advanced. And in terms of stocks which are unwinding, we can bring that up too. And ICICI Prudential, SRF, along with IGL, all looking at some amount of unwinding, but it's likely to be another very mixed year of trade, Alex, without any triggers in the horizon.
Thanks so much for that, Agam. Well, let's have a look at what's making headlines across the globe. Sue Keenan of Bloomberg News brings you the first word headlines.
U.S. Trade Representative Robert Lighthizer says he's going to speak to his Chinese counterpart to prepare for a meeting between Presidents Trump and Xi at the G20. Now, their talks are being touted as a possible catalyst to revive stalled trade negotiations. Lighthizer told the House Ways and Means Committee that the goal of talks remains the same.
When actual negotiations begin again, I can't say at this point, but we're clearly going to, we're talking, we're going to meet. And, you know, we have the same objective that you and the other members have, and that is that if we can resolve these issues in a way that improves this relationship, preserves the competitive advantage of the United States, we have an obligation to do that.
A United Nations inquiry, meanwhile, into the murder of Saudi journalist Jamal Khashoggi says that Crown Prince Mohammed's potential role should be investigated. The inquiry says there's no so-called smoking gun and there's no conclusion about guilt, but it does say there is, quote, credible evidence of high-level Saudi liability, including the Crown Prince. Khashoggi was killed at the Saudi consulate in Istanbul last October. The inquiry into the downing of a Malaysian Airlines plane over Ukraine 5 years ago has resulted in identifying 4 people it says are responsible for shooting down the aircraft. Almost 300 passengers and crew died when the Boeing 777 crashed, and investigators are blaming 3 Russians and a Ukrainian citizen. International arrest warrants will be issued next week, and court proceedings are set to begin in the Netherlands in March. New Zealand's economic growth, I should say, held at a 5-year low in the first quarter, leaving the door open for the RBNZ to cut interest rates again. GDP rose 2.5% from a year earlier, and that's the slowest pace in 5 years. It also matches the level in the fourth quarter of last year. The Reserve Bank cut rates to a record low back in May, and economists predict at least one more cut before the end of the year. Global News, 24 hours a day, on air and at TikTok, on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Sue Keenan. This is Bloomberg.
All right, some news from the merger and acquisition space here in India. HDFC will acquire 51.2% stake in Polo Munich Health Insurance as it looks to increase its presence in the non-life insurance play. The entity will be merged with HDFC Ergo upon completion of the deal. HDFC has already bought out Apollo Hospital's stake in the company. Shefali Malik brings you the details.
HDFC Limited is going to buy 51.2% stake in Polo Munich for about 1,346 crore rupees. This acquisition process is expected to be completed in 4 months. After that, it will be merged with HDFC Ergo, in which HDFC Limited holds about 50.49% stake. The contours of the merger process are not known at the moment. As far as the combined entity is concerned, in terms of gross written premium, it's going to be a number of about 10,800 crore rupees, which will make it a market share of about 6.4% for the combined entity. And the combined entity is going to be amongst the top 7 players when it comes to the general insurance industry. As far as valuations are concerned, HDFC has got a good deal. They've got, in terms of valuations, it's about 1.2 times in terms of enterprise value per gross written premium ratio. If we look at Star Health deal that happened earlier, they got about 1.5 times and Max Bupa about 1.2 times. So in comparison, in terms of valuations, this is a reasonable valuation which at which HDFC has acquired Polo Munich. And there's another angle to the story, that is Apollo Hospitals. Now Apollo Munich is a 51-49 JV between Apollo Hospitals Group and Munich. And Apollo Hospitals holds about 10% and Apollo Energy holds about 40% in Apollo Munich. So with this 10% stake sale by Apollo Hospitals, they're going to get about 300 crore rupees. And so one of the analysts was estimating that they'll get about 200 to 250 crore rupees for the same. So they've actually got much more than that. So big positive coming in for Apollo Hospitals. And with this, they'll be able to pare down their debt. The management had guided that they want to bring down the debt from 3,200 crore rupees to 2,500 crore rupees by March 2020. And they were also planning to reduce the pledged shares by about 50% by September this year and completely by about March 2020. So with this money coming in, it's a big positive for Apollo Hospitals and for HDFC as well.
All right, let's talk about some of the other stocks you have to watch out for in trade today. Somit Sarkar is joining in to tell you all about the stocks in news. Morning, Somit. What's on your list today?
Good morning, Alex. On the stocks and news, first we have is Adani Green, where the company has won a bid for setting up a 600 megawatt of wind solar hybrid power project by Solar Energy Corporation of India. Now the tariff for this power project is fixed at around 2.69 rupees per kilowatt hour for a period of 25 years, and the company is expecting this project to be commissioned by the fourth quarter of financial year 2021. Second on the list is Ashok Leyland, where the company has said that the Pantnagar plant will remain closed for 6 days, that is from June 24 to June 29, to align with the production and sales requirement. What they mean is that because of the slowdown in production, they will be keeping their plant shut for nearly 6 days. Third on the list is South Indian Bank, where the bank has received a penalty of nearly 10 lakh rupees from RBI for non-compliance with the direction issued by the RBI on guarantees and co-acceptances. Fourth on the list is IndusInd Bank and Bharat Financial. Now, boards of both the bank have fixed July 4th as a record date for determining the shareholders of Bharat Financial who shall be entitled to receive the shares of IndusInd Bank because of the merger that was proposed earlier. Now, the bank has also decided that that both the companies will consider the consolidated financials for the first quarter of financial year 2020 on July 12th. Well, last on the list is Sun Pharma, where the company has received a Form 483 from US FDA with 4 observations for its key plant, that is the Halol plant.
All right, thanks so much for that, Somit. Well, you must be aware of the GDP debate that's been taking place here in India over the past few weeks and months. Now, here's the latest. The Prime Minister's Economic Advisory Council issued a point-by-point rebuttal to former Chief Economic Advisor Arvind Subramanian's paper, which was released last week and which stated that India's GDP growth between 2011 and 2016 was only 4.5% as compared to the 7% that is mentioned on record. The PMEAC's paper said, and I quote, "A critique of GDP estimates must specify critique coverage or methodology. The author does neither." End of quote. Ira Duggal spoke to one of the PMEAC members, Ratin Roy, and here's what he said.
He's saying that there's a question with the fact that the GDP estimate that has been produced after 2011 does not correlate with these indicators. Now, when you challenge a GDP estimate, you can challenge either its coverage or its methodology. He does neither. He says the GDP estimate is more weakly correlated now than it was in the previous period, and therefore the GDP estimate must be an overestimate. I challenge that reasoning.
Do you challenge the selection of indicators? There's one part in the PMEAC paper where you say that it doesn't actually have any representatives of the services sector or the agricultural sector. But that would have held true even in the pre-2011 period, where some of those indicators were correlating with GDP, even though they were, well, not representative of services or agriculture.
Sure. So that would mean that there would be other indicators which would correlate with GDP when it comes to services. And because we are also measuring agriculture differently, and it would possibly mean that you would get correlation. So what if I had a situation where I had more agriculture and services correlations in both periods, and therefore I got an analysis where, let's say, 10 of the 17 indicators were ag and services and 7 were manufacturing, and I found that the correlation was reasonable in both periods. Your conclusion then would be, looking at what Dr. Subramaniam did and what we did and this other counterfactual, that there's a problem with the composition of manufacturing growth as measured in the GDP. Then you would go and look at how that composition growth has changed and what databases we're using. That would be a legit query. But in this paper, all this is only a prelude to the grand claim that India's GDP is overestimated. And I reject that premise on the basis of this article. It might well be, but not on the basis of this article.
Okay, so you do, would you accept at least that this break in correlation needs to be explained, perhaps indicator by indicator? You talk about one indicator in the PMEAC paper, which is credit growth, although I was a little confused about that argument, because I know that it led to NPAs, but that period of high credit growth would have led to higher GDP growth at that time, wouldn't it?
Depends on the lags. Depends on the lags, right? Credit growth doesn't automatically give you GDP. It depends on when you get the output that is consequent on that credit growth. And if you don't get any output at all, which is why you get NPAs, then you wouldn't get a rise in GDP, would you? Except in the first order sense. You would get it in the second and third order.
All right, in case you didn't follow some of those arguments, they're all displayed in a story on the website bloombergquint.com, so you can perhaps go through them at your leisure. There are a few other stories that I want to tell you about that's available on the website bloombergquint.com. Here are just a couple of them. Indian banks have initiated the process of signing a master inter-creditor agreement, which will govern the resolution process for stressed assets under the Reserve Bank of India's new rules, which were released last week. And speaking about bad loan resolution, rating agency ICRA has said that operational creditors recovered 42% of their total admitted claims from 92 debt-ridden companies under the bankruptcy law as of March. Next, the Enforcement Directorate on Wednesday, that is yesterday, arrested 2 former executives of the IL&FS Group in connection with its money laundering probe. Officials said former Joint Managing Director of the company Arun K. Saha and the group's Managing Director of Transportation Network, K. Ramchand, were arrested late evening in Mumbai under the Prevention of Money Laundering Act. All right, that's all you need to know going into trade today. Do stay tuned, though. There's a lot more coming up in just a short while. This is Bloomberg Quint.